And we're live.
Excellent. Thank you so much. Well, welcome everyone to this week's National Agent Call. As always, we're incredibly excited to have all of you join us in what is now, I guess we're on week 6 or approaching week 6 of our, at least for us in New York, of our shelter in place moment right now. I have an amazing group of speakers here today, two people who are, I think, the perfect people to be joining us right now, given all of the uncertainty and questions that exist right now around the overall economic environment and the housing market. And so couldn't be more excited to have both of them with us today. First, I want to introduce David Stevens, who runs his own consulting firm now, is the former president CEO of the Mortgage Bankers Association, was the former U.S. Assistant Secretary of Housing and Federal Housing Commissioner, and was also the former president of Long & Foster Real Estate, which was not only one of the, as I learned, biggest real estate in the country, but prior to its sale to Berkshire Hathaway a few years ago, was actually one of the largest privately held companies in the country. So welcome, David. We're incredibly excited to have you. And back for now the third time. I think at this point, Alli, you're like our resident commentator. We have Alli McCartney, who is the managing director of wealth management at UBS Investment Bank. And for her, our national call, I think, is almost like a practice round, because she's a frequent contributor to CNBC and Fox Business. And has been on TV a number of times, and so she's actually teaching me a couple of pointers about how to do the TV thing. As you all know, I'm waiting for that opportunity. So thank you both for joining. I want to start off and give everyone on the call a sense of where we currently stand. You know, as I shared with all of you on the call, we're going to focus this call today on trying to make sense of what's happening in the overall economy. You know, the news cycle is changing so quickly since our last few calls. We've had government stimulus programs. We had unemployment data released. We've had, talk of flattening the curve. I want to give us all a sense of where we currently stand in the economy and the housing market, and then sort of go from there. So first, Alli, can you help give all of us a sense of where do we currently stand? You know, we had the government come in with the CARES Act. We have pretty shocking unemployment data. Where are we currently right now? And then Dave, would love to hear from you from the perspective of the housing market, where we are.
Absolutely. Well, thank you again. I sort of feel like you all have become my virtual family, and it's amazing how far you reach. The tentacles that come back to me and sort of friends and degrees of separation has been really one of the lovely things about this entire bizarre experience. But so when we last spoke, we were, I think, firmly in and at the tail end of the first stage of this crisis, which was really public health crisis, come economic crisis, come financial crisis. And within that stage, the US and every country, quite frankly, had to decide from an economic and population perspective how to flatten the curve. We are now, both from an economic perspective and from a flattening the curve, we are now firmly in the second stage, which is sort of the navigation of what it looks like to have intentionally and holistically shut down our economy. And the third stage will be how we go into this recovery, which will certainly be very protracted in length. So let's talk about, what we've gotten past. We have gotten past panic selling. We have gotten past, I think, a general urgent and panicked or paranoid physical and emotional health response. We are starting to see the data bearing what we knew it would, which is that demand is down by between, if you're an airline, that can look like 95%. If you are an online streamer, that can be up. And if you are a restaurant or a retail chain, that largely looks like about down 25%. So we are just starting to be able to quantify, both from a US perspective and looking at trends and data coming out of Europe and Asia, what we look like and what the path of that looks like. And people are beginning to fundamentally, both individuals, pension funds, institutions, are beginning to take risk and get back into the market based on those numbers. And so you see a day like today and you sort of scratch your head where, you know, you wake up to see that 5.5 million people have filed for unemployment. That means that we have now had 20% of the country file for unemployment, right? We're looking at 1 in 10 to 1 in 8 people are unemployed. We're looking at an unemployment rate of about 10%. Likely the consensus is going to about 15%. And we have 20 million jobs that have pretty much vanished overnight. To give some context to that, the worst weekly jobs or lack of jobs unemployment report during the financial crisis was the horrific number of 695,000 unemployment claims. So we're basically now at a point where if you look at it from a temporary perspective, every job that was created since the financial crisis, and it's actually quite inspiring to understand how that was 20 million jobs, now has vanished. So the question becomes, when do those come back and how do those come back? And so what the market is looking to now is, do we continue to have control over the virus? As Cuomo said, I think in a really lovely way, a friend of mine told me she was a Cuomo-sexual the other day. I'm learning this whole new series of terms about people's love for effective government. But Cuomo said, we have proven that we can define and mitigate the disease and that the disease does not rule us. So that's really important. The second is the path to a cure, an inoculation, a treatment that lets people, instead of worrying about the concept of life or death, make decisions on what they do and on both consumption and working based on sort of being sick versus not being sick. And the third is, you know, what does the world look like after this? So today we had massive unemployment, 20 million people out of work, but the market reacted to the positive silver lining, which was that the delta, the change in those numbers were negative, i.e. less people filed for unemployment this week than the week before and the week before that. So that's what really the markets look like, is this sort of delta decline over time. A little bit concerning still, and I think why you see the market going back and forth today is has to do with the earnings that have come out, which have been, I would say in general, bad, but not awful. And the next issue that we have is that the $345 billion that was put in place for the CARES Act has been completely and totally expended. Not to say that everybody who filed through their business bank and was approved has actually received that money, but that all of the money has been spoken for. So, you know, I would say that the economy, like myself and like many of you out there, I think has become, and investor sentiment has become slightly optimistic. We're seeing buds on the trees. We're seeing dampening of the curve. We're seeing some businesses, you see Amazon, Netflix at all-time highs, accelerating. And we're sort of now in this tale of two cities approach to the economy, which is that those companies that have a great communications platform, a great technology platform, and that have distributed consumer services, you know, we can see a path for those and we can start to quantify and build in. Those that don't are likely to be punished. And so I think this tale of two cities will continue. The last thing I'll say on this is that the last 10 years has really been a story about investing in equities. Right now, you're seeing a great deal of conversation about the ability to earn excess returns in fixed income markets. So buying bonds of companies especially those companies that are being helped by the Fed. The Fed has done in 6 weeks 4 times what they did during the financial crisis. And with the exception of what we call Japanification and actually buying equities, which is one of the things that keeps me up at night in terms of long-term negative consequences, the Fed has supported our economy to the extent that they last week, at the end of the week, surprised the market by saying they would lend to and support cities, municipalities, state governments, and investment grade debt. So those companies that were at investment grade, that were considered the safest of the safest, and have since, because of their business models, because of their exposure to this virus, fallen. So there's a cautiously optimistic environment. I think we probably have less upside potential in the near term until we have a lot more clarity than we do have downside potential. But there is and I will leave it at this, obscene amount of money earning nothing in the system. And I do truly think, maybe not tomorrow, maybe not next month, that is going to benefit each of you and your clients, because the concept of having all of that cash in this market with the opportunity cost or an interest rate at 0 and the desperation to hedge against what that means, which is future inflation, real estate is one of the greatest assets to own in that scenario.
So, to that point, Dave, what are you seeing from sort of the real estate perspective at the sort of macroeconomic level where we are right now?
Yeah, I mean, I think the comments that I just made were excellent. There's a lot of people looking at this from an economist standpoint, and I think collectively looking at the work is helpful. Mark Zandi, who's the chief economist for Moody's, has put out some really good stuff on this as well. And I think it's really important for anybody in real estate to realize this is not the Great Recession. So the Great Recession, to remind us all, was built on, primarily hyperinflation in real estate values, funneled by weak credit. And, negam, subprime, you name it, that built up this like enormous enthusiasm for real estate, also complemented with lack of demand. So if you look at household formation back in 2007 and 2008, the only growth in household formation was in rental housing. There was actually negative household formation in home ownership. Why is that? The millennials were still living at home and in college. At that time, when I was in the administration in 2009, I joined the Obama administration right at the very beginning. I had a household of 6 people, my 4 kids, my wife and I. Today, we make up 5 different households. My daughter's on her second home. So, that huge demographic, which is bigger than the baby boom generation, it became plain in real life. And so all the weaknesses of that period are entirely the antithesis of where we were just 6 weeks ago to you, 32 days down in the DC region since we've been locked away. But it's very different because we had a really strong economy. We had historically low interest rates, and we had peak demand for housing. In fact, what we were all talking about just a couple of months ago was a shortage of affordable inventory. That was our biggest worry of the year. We weren't worried about refinancing. We weren't worried about demand because that's extremely active, especially in the entry level and the first level move up market. And those fundamentals are actually likely to help us come out. I'd be curious what our economist thinks, but this is a really bad recession, but it's not brought on by a credit event. This is a recession brought on by a pandemic. And to a couple of the points made, first and foremost is how the government has responded. The Fed was so quick. I applaud Powell. He came in with a little too much enthusiasm in the beginning. There was an excess of mortgage-backed securities in the market, and he came in and took that excess supply out to an extreme, created a huge short, which drove rates even lower on 10-year and more. But that almost took down a bunch of lenders who had hedges on mortgage pipelines, and I won't go into the math on that, but it was they came in with guns a-blazing. He actually also figured out that he had stepped in too much and backed off, and that's why we've seen all the pipeline risk and the risk to a whole bunch of lenders across the country subside dramatically. So the Fed was awesome. And they're still there. And if you listen to Powell's interview, you can pull it up online, but he did an interview with Brookings last Thursday, and he reiterated he's in this, he's going to be in this, and he has sort of an empty checkbook, a never-ending checkbook in terms of stepping in and supporting the markets. So that's step one. We have this incredible piece of legislation, the biggest quote-unquote bailout in American history, signed into law in a bipartisan fashion, which who would have thought we could have done anything in a bipartisan fashion, given the extraordinary polarity that exists today. Literally everybody signed on to that bill except for a few libertarians, and the president signed it into law, and that threw money everywhere. And what you want to do in a recession like this, just like we did, like happened in 2008 and 9, is you want to get enough money infused in the economy to cushion the blow and to help bring the recovery back. And so, where are we today? It depends where you are. I mean, Pennsylvania, the governor has a law that you can't close loans. You can't purchase transactions. You can't do inspections. You can't have appraisals on properties. And so, those kinds of things, which are being prudent or unprudent, however you view it, they're measures being taken by political leadership to try to protect the people in their states. And I'm a Cuomo fan as well, so I think he's an example for the rest of the country. But nevertheless, there are some technical aspects that may inhibit real estate transactions here in a very short period of time. But we need to remember the core value proposition here. We were humming. We were ready for a great spring market, almost in any market, any community across the country. The demographics of demand haven't really gone away. These young buyers, they don't have a lot of money in the stock market. So that volatility, as sort of an example of where volatility could hit, isn't going to bother them as much. And, the real question is, what happens here? Mark Zandi has sort of a W-shaped recovery. So we're in the huge spike down now. We're literally in the peak of it kind of last week and this week, and the unemployment data and all that's sort of shocking us. We're seeing the death numbers every day on television. It's frightening. We have friends or family members somewhere that we know, either directly or indirectly, who've been impacted, and all that's scary. And so, that impacts our emotions, especially emotions for all of you as real estate agents. But you need to realize what many economists are saying is, at some point, we're going to go back to work. And so whatever this massive drop in GDP, we're going to see a quick reversal. It won't go back to where it was. We're still going to be in recession for a period of time, but we are going to see suddenly a leap. So we'll see a quarter over quarter change that's positive almost instantaneously when we go back to work. Now, to all the points made previously, timing of getting a vaccine, recurrence risk in states that go back too early, all of those kinds of things are in play. And so, to look at what many economists are saying, we'll come back. We'll see it suddenly. A lot of companies will open up. Restaurants may not be able to seat people as closely together as they want to or used to, but they'll try to open. Retail stores are going to have the biggest Black Friday sale we've seen in history. They're going to want to try to get as many consumers to buy stuff from them as they can. They're going to have to hire people to operate these places. We're in summer. Landscapers are going to have to go to work and build stone walls and outdoor fireplaces and whatever else they do. So we're going to see reemployment. It won't cover all the markets in their areas. I saw a ghost town picture of Las Vegas this morning. I'm not sure how quickly people are going to be jumping on planes, going on vacation to places that depend entirely on vacation for a living. But, my expectation is we are going to bounce back as a nation quicker because the demographics and the core fundamentals of our economy were so strong going into this that it's going to at least help us have a better wind at our back. And I'm completely in agreement about the housing. Household formation, as I said, we were losing owner-occupied households in 2007, 2008. If you look at 2017, 18, and 19, we were creating well over 1 million new owner-occupied, mean purchase households per year. It was a net change from that period to now of about 1.5 million units if you take the negative loss we were having back during the recession period. So those demographics haven't changed a lot. Will they be delayed? How quickly will people be reemployed? That's going to be, we have to watch that pace of change. And a lot of that has to do with how how we respond, how the response to the virus happens, and what time frame communities open. But most people are expecting we're going to have an opening sometime in May. Trump, with or without being involved, many states are going to follow whatever Trump says immediately. Others may delay because of their own views about the pathway forward. I'm not going to get into the political game here, but in the end of the day, I think real estate is going to be, all the fundamentals that were driving us to what was going to be a multi-year positive growth, positive expansion in residential real estate. Those fundamentals maintain, and I can't imagine being in a better business. And I think there's going to be an immediate pop in purchase transactions the moment we get out of here. Cook has one last point. Ivy Zellman, I don't know if you know Ivy. She's in New York. She does a lot of analytics. I was talking to her the other day, and she's doing a lot of surveying right now, and she's finding that with renters, particularly in high rises and multifamily buildings, they're getting cabin fever in a manner that's making them think, man, as soon as it's over, I want to get into a house. I'm never going to get stuck in 700 square feet again in my life. And so, I just think there's going to be opportunity here. I don't want to be overly Pollyannish about it, because I think we will have quarter over quarter pop the moment we go back to work, and I think we'll feel that. The unemployment numbers will shift dramatically immediately, but then we'll probably begin to trickle down again on a quarter by quarter basis back into sort of single digit moves from these dramatic drop and dramatic sort of halfway back dramatic increase. But for all of you, I think we ought to look forward to what's going to be a good market. The last point I would just make is the biggest challenge we're going to have for what I do, which has been in real estate finance my entire career, is going to really reflect what policymakers in Washington do about making sure they're creating enough liquidity to help the mortgage banking community get through this, because there's a huge tightening of credit that's occurring right now, which I think is going to be harmful for us as we try to get into recovery.
Yeah. So I would love to talk about two of those things that you mentioned, one anecdotally and one more quantitatively. So one of the things that's very interesting about the perspective that my team and I get on the market is, we all ran trading floors. We all are sort of in the weeds of some of the more technical aspects of the market, but we work with high net worth individuals and we get to see what they are thinking. And to all of the points just made, I have had 4 conversations in the last 24 hours, all of whom either want to upgrade their second home or are looking at sort of changing the way they live their life and going from, well, we were all in New York to now we think maybe I'll just be in New York and they'll be out here. And there is a knowledge in the high net worth base that what happens is there is a cycle and a time lapse between liquid assets, i.e. cash, bonds, and stocks, and illiquid assets, i.e. hedge funds, companies, and real estate, and when those opportunities become available. Now, the biggest challenge with that you're seeing now, again, to the points made, is that for 2 reasons, it has become very difficult to get a mortgage. Yeah. The first reason is because logistically, the way many banks, UBS included, Wells Fargo, JP Morgan, where I worked, First Republic, you name it, the way that they moderate and control the level of interest in applications they're dealing with is by toggling rates up and down. So in a perfect world, you look at the 10-year treasury and you say, that's what we're going to base the mortgage rate off of. And so every day I'm getting the question, why is the mortgage rate you're offering me so much higher than what I see? And the answer is A, the volatility, the up and down, and how quickly that 10-year is moving from 1% to 60 basis points, to you name it. But the second is the toggle that banks are using in terms of charging. And I would say there are 2 toggles right now that are important. The first is the rate, and the second is the percent down. So I, for the first time in my career, have seen that UBS on, let's say, $3 million purchase price with what used to be 10 to 20% down is now mandating 30% down. Wells Fargo, which used to be sort of the most, I would say, democratic place to get a mortgage, won't even look at underwriting or taking applications if you don't have $200,000 to $250,000 to move to them. So you're starting to see that sort of toggle and necessity for either additional liquidity or additional money down. Second is that when you think about the fact that we have had millions and millions of applications for credit or loans or grants through the Small Business Administration and commercial banks, those resources that they use to underwrite those loans have largely been taken from their credit card and mortgage underwriting. So they've taken all of their people and technology and moved them from provision of credit in the mortgage space, which is very lucrative for them, and moved that into underwriting these loans for the government, which are not as lucrative. And so that has repercussions both for banks and their position in the upcoming months to year, and for mortgages. So I think that, what that says to me is that, there will be a point at which we all get more creative. There will be, there is definitely demand and desire and need out there. And I think that with having retraced half of our equity lows, people are starting, the conversations I'm having are rosier, right? They don't feel, they feel concerned. They are concerned about the health of their family. They're concerned about their financial well-being. But again, they're not panicked. It's a very different palpable level. And myself, when you see the mechanisms in the market absolutely fall apart, versus when you can say, as I said at the beginning, that you can understand why markets are moving, and they're moving with directional and volume and liquidity in the system, it's a totally different beast. So now the question is, and actually while we were on this call, it came out that New York and the tri-state area are likely going to be stay at home till May 15th. The market didn't really move. It moved a little bit negative on that, but not hugely. I think what was priced into the market was this concept that China's back to work and hopefully seeing less in terms of reinfection and mutation. By the way, some of the Chinese retailing right now, there's this whole concept called revenge spending, where instead of buying one Louis Vuitton or Coach bag, people are now buying two, where there's almost this increase in demand as opposed to just a return to within normalcy of demand. There's a lot of really positive out there, but especially to those of you who work in markets where things are contingent on mortgage financing, that's going to be an area you're going to have to follow and watch closely.
Yeah, to Alli, on that, real quick before because I want to get to this point around what the sort of next step the government can do to help that. Real quick, what sentiment are you getting from your luxury, let's call them luxury clients, but your high net worth and ultra high net worth clients, maybe the clients that your colleagues work with, on when they are they feeling comfortable around making those transactions for homes now, or are they waiting because their equity portfolios and the value of the stocks they owned is still down relative to what it was a number of weeks ago? Are they getting ready to move, or they're still on the sidelines?
Well, so there are the logistical issues about, I've gone through some moves with people. Social distancing, moving is not anything I would wish on anybody. So there's that logistical issue. And I know we've talked about this on the calls, and it's super interesting to see how creative you are all being and how you can see houses, et cetera. But so there's that concept. How do I even do this if I want to do this now? And then there's the concept of, I would say there are a lot of clients for whom we've been talking about second homes in Florida, the Hamptons, New Yorkers that like Arizona, New Mexico, California, and they are actively looking, right? Because these, again, aren't people that need that mortgage contingency, and they understand that whether they pay for it in cash or not, there's likely to be money poured into the system that's going to create a rising tide for all assets, and they want to be part of that. The other thing that I don't want to ignore is the human element in buying. And again, this was touched on. which is we have all spent an inordinate amount of time in our homes, right? And when I get on the phone with clients and they say, where are you? And I say, I'm in my vacation home in Montauk. God, thank God I have this place. What it does for my spirit, seeing the ocean, what it does for my kids running around. And so there is a lot of that. I think you're going to see people that, just like you're seeing a lot of money right now, some of the areas that are doing well are like home goods, right? People are spending a lot of time in their home and they're realizing how much personal and emotional benefit they get from where they are. And so those people that are waiting on the sidelines to buy a second home are desperate to have and identify that second home. Those people who have the ability to upsize, those people who, quite frankly, don't like the fact that the markets are probably back to historically high valuations. If you look at trailing 12 months, they'd much rather be in a position to use cash as king and buy from a distressed seller in real estate. So I think there are a lot of things. Owning assets that protect you from inflation in a zero interest rate environment, being able to be opportunistic about distress in the markets if you have cash as king, and the personal experience of understanding more than ever in life how important surroundings are to physical and emotional well-being. I think you're going to find all of those three are going to influence your buyers when there's an opportunity. Now, again, and one more logistical challenge, and then I'll back off, is, I have a family right now in Westchester that's doing a transaction. I can't tell you how many hours that we've spent trying to figure out how Connecticut, because that's where their lawyer is, and New York State are dealing with notaries, right? Mm-hmm. How do you do notarization of things right now? How do you actually switch a title right now? And again, like was said, state by state, we're starting to figure this out, and it's starting to feel a little bit smoother. And just like once the Fed pumped liquidity into the system, the pipes of the fixed income market are working. I think once cities and municipalities start to be able to think about anything but ventilators and hospitals, which we're at that point now, they will lubricate the pipes of the logistics and administration capabilities that allow buying and selling in your market to continue.
Yeah, it's interesting you mentioned that, because as we, across the country seen, this question arise of, is real estate an essential or a non-essential service? And, the conversations many of us have been having with our local state and city governments, the suggestion that they would even be able to get an answer on that, to me, is crazy. If you're the leader of a city, a municipality, or a state right now, probably the last thing on your mind is whether or not real estate's an essential service. It's, do I have enough ventilators? Do I have enough hospital bed capacity? Do I have enough masks for those frontline healthcare workers? So I agree. I think as that starts to calm down, we'll get more focus there. Dave, if you were in the government, in the Obama administration, so you've seen this from that perspective. We wave a magic wand, and you're in charge of the next step of stimulus that comes from the government. Alli mentioned replenishing the small business, financing opportunities. 350 billion. I think a lot of people said that was pretty low relative to the need. What is the first or most important thing you would push on? Would it be that? Would it be further stimulus to individuals? Would it be a commitment to infrastructure spending? I mean, what do you think is the best next step that the government can take there?
So let's just talk about our industry first. We have a real problem going on. So the administration, the Fed stepped in, they helped drive rates low and took out the excess in the MBS market, mortgage-backed securities market, which helped drive rates lower. Alli's already explained one of the reasons why mortgages haven't come down to be somewhere within range of the 150 basis points of the 10-year that we normally expect. One point that you just didn't cover there as well is servicing. Mortgage servicing makes up part of the interest rate, and mortgage servicing bids have all but dried up. And I won't get into too much technical aspects as to why that is, other than to say this forbearance plan that was part of the legislation, it allows any homeowner who's in a government guaranteed program, that's Freddie Mac, Fannie Mae, or the Ginnie Mae programs of FHA, VA, and USDA, to simply not have to make their payment this doesn't require any proof of hardship. When I was in the Obama administration, we implemented a forbearance plan, but out of concern for what we called moral hazard, we required borrowers to prove that they had lost their job, that they couldn't make their mortgage payment. This allows anybody to jump into the program whether they can afford it or not. So the numbers of forbearance are growing dramatically, and I'm getting numbers from all the largest servicers on a daily basis, and they're growing each day. And the problem there is that once a borrower goes into forbearance, the borrower doesn't have to make his or her mortgage payment anymore, but the lender, the servicer, has to still advance that payment to the mortgage-backed securities holder. So estimates have been made by many that if this gets anywhere near, say, 25%, right now it's at about 10% of all eligible mortgages, we're talking $70 to $100 billion in expense over the 6 months of forbearance. There's no liquidity in the servicing market to do this. Banks can tap into the Fed window, Federal Home Loan Bank advances, or other portions of their own companies to be able to back that up. But the majority of servicing today is held in non-banks. And through no fault of their own, they've suddenly been thrust into this environment where they may not make it through based on not having simply enough liquidity. And that's causing an extraordinary credit contraction on its own. Just to give you an example, I use JP Morgan, since we have a former employee of JP. They put out a policy that for correspondent loans, that's loans that they buy from other lenders, not brokers. They buy from other typically non-bank lenders. You now have to have a minimum of 700 credit score. 80% LTV is the max. And if there's a self-employed borrower, they have to have 12 months in reserves. That's basically saying we don't want the business unless, I hate to say it, you're really rich and you're really white. It's kind of how that's going to look. And so the problem with JPM making a move is when they make a move, others will tend to follow, whether it's Wells, JP Morgan, Bank of America, US Bank, any of the big lenders in the market, because nobody wants to have adverse selection. They don't want to be the ones with the bad credits and the other guys are getting just the good credits. So you tend to see these moves upward. So literally on an intraday basis, we're seeing minimum credit score requirements rise, 640, 680, some are 700 on refinances. And that's happening, at a dramatic pace because we're in such a volatile period during these few weeks here that you literally don't know if you had a loan in process that originally you thought would be approved, whether it will be approved, because suddenly the noose is tightening around the credit availability market. A lot of that is being driven, one, by uncertainty about how many people are ultimately going to go into forbearance, what's going to happen to long range reperformance after that, what's going to be my ultimate default rate, how does that affect prepayment speeds, what some people call convexity. I mean, all of these are going to be built into the determination of where you establish credit parameters. But a big chunk of it right now is nobody wants to get caught with a big non-bank lender who runs out of liquidity to make these advances, which was thrust on them through no fault of their own. And so they're putting limitations on what you can originate, what you can hold in warehouse lines, what you can sell through correspondent channels. All of this is very counterproductive. So step number one, what I would do is require either the FHFA director is an independent regulator, but I would try to cajole the FHFA director into having the GSEs set up their own liquidity facilities, or between Treasury and Powell, have Treasury fund Powell to be able to set up a window, a facility where they could exchange MSRs, mortgage servicing rights, in exchange for liquidity to make these advances. Certainty in markets is the most important thing right now. Powell's been very specific and focused on trying to create certainty, and he reiterates it every interview he makes and talks about it, and he's doing it with his actions. That legislation, that massive bill, which will obviously be followed by another one, is an effort to try to create confidence and stability in the markets broadly. And this, however, was thrust upon the mortgage servicing world because of that legislation, and nobody backed it up. And it's really, unfortunately, in my view, the obstinance of the FHFA director, who's not playing along with the way the White House is, or Congress is, or the Fed is, to try to keep these markets functioning. And in the midst of that uncertainty, we're seeing credit contract more so than it otherwise might. And that's affecting all of you. That's affecting all of you in terms of, what are the mortgage terms now? Where's that puck moving to? And how do I understand where we're ultimately going to end up? So that would be job number one. I'll leave the rest to our expert here. But small business, I would just say, if you don't have a friend who's a small business owner who still hasn't been able to get an answer about their loan, you don't know any small business.
Yeah. So, there's definitely you hear that every day. I think there's not a day that goes by that we don't hear that. Actually, if you you wave a magic wand, what would be the next step from the government perspective that you would instruct them to make?
Hello?
Yeah. Oh, Alli,
we're going to need another stimulus bill, and it's
looks like you're cutting out. Looks like your audio is cutting out a little. Alli, just to jump in while Dave's audio comes back. Your perspective on what sort of that magic wand step you would.
Absolutely. So, so to David's point, and he's obviously expert both in the credit mortgage market and in DC, he's absolutely right. And all I can tell you is everything that is done, whether it was in response to the global financial crisis or GFC in 2008 and 2009, or whether it's in response to unforeseen consequences or unpredictable secondary effects or echoes, has been done expediently. The US is fundamentally we are still supported by entrepreneurship, by home ownership, and that is part of the American dream. And I am completely and totally confident, as is UBS, that the government will do anything and everything it has to do to bring that back. It, as you said, is going to be secondary to the health and safety of its people, but it will absolutely happen. I think that the government has really done, from a federal perspective, everything you can. Every time Powell speaks, as David alluded to, he literally uses the words, "We will do anything and everything that needs to happen." I think even in our last call, we would check the box and say the Fed has done what it needs to do. And to update you on what it has done, between the Federal Reserve and the fiscal government, we have input into the American system over $12 trillion. That is over 50% of our annual GDP. That is unthinkable. That is heroic. Now, the next part of that, though, is the fiscal part. So we have come in and we've said the Treasury and the Fed basically have unlimited resources and an unlimited balance sheet. But the question really is, how do we get back to the economy we came into, which was driven by a strong and employed US consumer? And that is more about the fiscal side, right? So that's more about tax payments deferral. That's more about what happens with state and local tax. That's more about what's actually going out the door and how quickly we can get another $350 billion on the table. So I would say if we can balance those two things, which are fiscal and federal, which are systemic and which are consumer and demand oriented, then we'll be okay, right? And so the question really becomes, is the amount that's been done to date sufficient to cover for or insulate joblessness? And the honest to God answer is we don't know. We have had, this is the first week of US earnings. By the end of the week, we'll have about maybe an eighth of companies having reported. A lot of companies are declining to report, which is not a usual thing. There are some companies opportunistically reporting early. There are some who will push. But unfortunately, the answer to a lot right now is cautious optimism, but we have to wait and see what happens. And just as a point to let you know how quickly things are happening. So if we got on the phone 40 minutes ago and 20 minutes in, the tri-state area announced May 15th, the markets have moved on that, right? And so there is this constant day by day. What does every day that people are out of work look like? What does every day we're not going to retail establishments? And the long-term consequences are still super, super unclear. But what is clear is there will be winners and losers. There will be bankruptcies and a lot of M&A activity. And, and again, there will be, once we get to that new steady state, that new normal, which is probably, if you ask UBS, that's probably not, honestly. Some people say end of 2021, when we get back to GDP that's commensurate with where we were in 2019. We think that's probably, from you talk about a recovery, whether it's W, ups and downs, whether it's U, so it's prolonged, that's probably 2022. And not that there is not going to be intermittent transactions between that, but in terms of being able to sort of fully go, we did it, that's a while in the future. And so everybody's looking towards literally day by day, when is that and what does our path look like to get there?
Yeah, I think it's interesting, both of you sort of talked about, different ways, sort of the demand side, home buyers. I think prior to this, I remember I read an article back in December in the Washington Post that said millennial buyers are the biggest cohort of buyers now in the country. And to your point, David, same example. I think 10 years ago, when we were going through, or actually at this point, 12 years ago, I think back to my own family, all my siblings, we all lived at home, and now we all live in different places. So it's an interesting point. How do you guys think this actually impacts demand on the millennial buyer side? Because it's sort of, on one hand, you have a group of people who were saddled with a lot of student debt, so haven't been able to save a lot. On the other hand, you have a lot of people who didn't participate in the equities markets. They didn't lose a lot of money in the stock market. You had people saying the millennial buyer won't value homes in the same way that the baby boomers did, that Gen X or other generations did. But we've all just spent 4 to 6 weeks in our collective homes, and I think everyone is going to come out of this recognizing that actually the home is so valuable. So that could flip that entire concept on its head. Where do you guys, Dave, just starting with you, where do you see that pushing that group of buyers over the next couple of months and probably for the next few years?
So first of all, can you hear me?
Yes.
Okay. So there's a multi-pronged answer, but let me just try to lay it out this way. First of all, Fannie Mae does a home ownership sentiment study every year. And in their home ownership sentiment study, well over 90% of all millennials want to own a home. So do they want to own homes? Yes, they do. They've been delaying their purchasing decisions. So the age of home ownership, of first-time home ownership, has risen. The New York Fed puts out a data chart, and it's the percentage of Americans at the age of 30 who have a mortgage. That's an indicator as to when people jump into the housing market. And it's about 10% lower than it's been traditionally over the previous couple of decades. So they're delaying their decision to buy. They aren't buying as early. And a lot of that has to do with things as you highlighted. Student debt. They want to have greater confidence in their careers. They're getting married later. They're delaying some of the permanence of life decisions that creates the motivation to buy a home. Nevertheless, they're now moving in. The cohorts of the millennial generation that are in late 20s, early mid 30s is now significant, and that's where why you're seeing the demand and why you're seeing the shortage of available inventory in the marketplace. I actually am. We do have headwinds. We have student debt as a headwind. We have saving for down payment. Now, one point you all need to realize, this doesn't deal with the 1% clientele that you've been talking about earlier, but for the entry-level home ownership for the millennial generation, 2/3 of them are minority. If you look at existing housing stock in the United States, 70% is owned by white non-Hispanic. If you look at the formation demographically of household formation looking out the next 10 years, this is from the Harvard's Kennedy School's Joint Center for Housing Studies, 2/3 of those are going to be minority, with only 1/3 being white, non-Hispanic. So we're seeing a massive shift here. challenge is minorities don't have inherited or generational wealth, meaning they can't get mom and dad typically to help with the down payment. A large percentage of them will be the first in their families to buy a home. So I'm appealing now to the other side of your real estate agent pool that deals in the first-time home ownership market. And the variables there are going to come down to understanding what it takes to buy a home. NAR just put out a great report this morning talking about that piece, the misunderstandings of buying a home, and that you can get it with a low down payment. You guys know this. We've been fighting this battle for years. But you can get a loan with 3% down, and plenty of folks doing down payment assistance like Chino and others, where you can do it with no down payment. But we need to get that information out to that community that is eligible to buy. And the second then is affordability. Do they have too much of a debt load from student loan debt or otherwise that makes them unable to qualify for that mortgage? That's the second biggest point. So down payment and affordability. And then the third is credit availability, which leads into the same bucket. So available inventory, putting pressure on communities to give incentives to home builders to build more entry-level housing and eliminate some of the red tape, the disincentive to build entry-level housing that exists in this country today. I mean, there's just a lot of public policy work that has to be done here. But my own sense is that the primary issue is not desire. Clearly, debt and down payment are going to be part of this, and availability of affordable housing stock are going to be part of this. And then the key of the right cohorts of the millennial generation reaching those age bands where they're now going to start buying and move out of the rental market. And I think we're actually really on the tipping point of that last point, but the others are variables to consider. I'd be curious what our economist thinks about that.
Yeah. Alli, what are your thoughts there?
So the first thing I would say is that to build on, and as further proof for that, one of the things that keeps economists or investors optimistic right now is that coming into this, remember, we were 11 years into the longest, not the most significant, but in terms of tenor and time and pure days, the longest bull market ever experienced. That was driven largely by the lowest unemployment and coincidentally the strongest individual balance sheets, the least level of indebtedness, the highest level of savings. So we came in, again, taking sort of the 1% off the table with really, apart from those large headline issues, really historically healthy consumers and home buyers. They were overwhelmingly buying in these sort of second tier cities, motivated by entry price, motivated by space and quality of life, and motivated by all of these long-term transformational things like ability to work from home, desire not necessarily to be tied to one area, and that area being New York. But what I can tell you is we will get back to there. We absolutely will. We'll have a new natural level of unemployment, which takes all of this and the gig economy into the picture. But the question is, when we get back, which of those phenomenons that we were seeing, whether it was multifamily, whether it was second tier cities such as Nashville, the Seas in Ohio, all these kind of things, which of those are going to come back and which are going to come back quickest and which are going to be reinforced. But the only thing that I can tell you is, for example, and this will be, I think, my parting notes to you. I am actually, for some of my clients, going back into the mortgage market as a class of investment assets and credit that have been broken and where there is opportunity for outside returns from an investment perspective. And a lot of that is based on the fact that if you look at pre-global financial crisis and coincident or sort of just past home buyers, those homes have appreciated on average about 50%. So anybody that took a loan has continued to pay it off. And as a percentage, it has continued to go down based on their paying it off and the equity they have in those homes going up. I completely and totally expect that to continue over the next 10 years, right? So when you talk to people in the investment industry, what the Warren Buffetts of the world tell you right now is, I can't tell you what it's going to be like tomorrow. I can't tell you what it's going to be like at the end of the month. But what I can tell you is, in 24 months, in 10 years, in 20 years, this will be a generational buying opportunity, of which I and my peer sets in my 80s have seen 4 to 5 in our lifetime.
Yep.
And I think that is even more true in real assets. As you talk about, cash has gone to zero again. There's a lot of it. Inflation is going to be exorbitant over the long term. The dollar is going to weaken. The flow of capital into this country and the desire to do that in a tangible way, especially when you compound the emotional connection with home ownership and real estate that we had as a universe, and will now have even more, having been so confined and married to our homes. So I have no question that real estate is an asset that should be part of a client's investment or personal portfolio going forward. And I have no question that it will appreciate over time.
Yeah, I'm not just saying it because I'm in the real estate business, but I couldn't agree with you more. The last thing sort of I'll leave you with, as we're on this call, my wife's in the other room, she can hear me, so she's been texting me live updates from luxury fashion clients in China. You know, she works for Kering Group, which owns Gucci, Saint Laurent, Alexander McQueen. And so in China, week to date so far this week, and they're looking at it week by week, their stores are up 18% compared to the same week in 2019.
There you go.
The swing by store ranges are, some stores are down 58% on the year compared to last year. And that's on the low end. On the high end, some stores are up 110%. Leonard Steinberg shared an email with everyone a couple days ago where he, cited that an Hermes store in China sold $2.7 million of luxury goods in one day. So, in a country that is, supposedly a few weeks ahead of us, we're seeing some positive signs come out of the luxury side as well. We're just at almost 1 o'clock. Before we end, real quick, my question for everyone who joins us on these calls, what are you doing to keep busy and stay sane while you're stuck in your home? Dave, you first.
Well, I'm fortunate that I'm at our lake house. And so I have a boat, and it's a big lake, and we're enjoying spring coming our way. But I also have a very active consulting business. And frankly, it's gotten busier given all of this. So I'm staying busy that way. But my wife and I are here, and our dog, and we're enjoying living on the lake and hoping to see our grandchild and our kids here as soon as we can.
Aww.
Oh, that's awesome. Have your activities shifted, or we're still going to be hanging?
I still need music.
Yeah.
The weather has been disgusting, so the beach aspect has been so from afar that someone who saw me on TV said, "Oh, do you have the mountains behind you with all that mist?" There's one place open in Montauk, New York. It is not the 7-Eleven. It is not the bake shop. It is the Candied Anchor. It is the candy store. I've never eaten so much candy in my life. My children are obsessed. The other thing I would say is we're a little bit of a dorky family sometimes, and there is a New York Times app that has these things called anagrams, where there's it's like a honeycomb, and there are different letters, and you make up words. We have teams. It's me and my 8-year-old and my husband and my 10-year-old. And there's a different one every day. And that has been actually really fun and a good way to teach the kids words. And they get that. They sometimes are better than we are, which is hilarious.
It sounds better than watching TV. So I think that's probably a good thing. Thank you both so much for joining us. Dave, Alli, thank you guys. Looking forward to having you join us again. Hopefully we're doing a call over the summer where we're talking about how optimistic we all are about the bounce back and what the next number of months look like. So I look forward to that. Thank you guys again. Have a great
Be well, everybody.
Good to be with you.